Why did China obliterate technology giants? Signs of the future of technology. Over the years, China's technology industry has become one of the main drivers of the country's economic growth. According to a McKinsey report, the technology and internet sector will contribute about 7% to China's GDP by 2022, equivalent to nearly 1.3 quadrillion yuan, approximately $200 billion. Tech giants such as Alibaba, Tencent, and Baidu have not only shaped the economy, but have also created millions of jobs and driven innovation in many sectors. However, this rapid growth has also led to major concerns about unfair competition, privacy, and data security. I asked myself, why is the Chinese government so heavily involved in its tech giants? These decisions affect not only large companies, but also have profound impacts on consumers, the economy, and society as a whole. In this video, I'll walk you through the main reasons for this disruption, along with some shocking numbers that we might not expect about the impact of the tech industry on our daily lives. Join me as we explore historical context to better understand why the Chinese government is interfering with tech giants. We first need to look at the historical context of China's tech industry. Since the start of the reform and opening up policy in the late 1970s, the Chinese economy has undergone dramatic changes. Around 2000, the internet began to flourish, and technology companies quickly emerged, playing an important role in the modernization and economic development. In 2015, the Chinese government announced the Internet Plus plan to encourage the application of digital technology in all sectors of the economy. This paved the way for the development of companies such as Alibaba, Tencent, and Baidu. Alibaba, with its e-commerce platform, recorded revenue of up to $109 billion in fiscal 2021, becoming one of the largest e-commerce companies in the world. Tencent, in addition to its WeChat messaging service, has also diversified into areas such as gaming and e-payments, with revenue exceeding $82 billion in the same year. Baidu, considered the Google of China, is not far behind, with revenue of nearly $19 billion thanks to search advertising and AI technology. Despite this rapid growth, the boom has also posed major challenges. The tech giants have helped create a fiercely competitive ecosystem, with many large companies racing to attract users and dominate the market. This competition has led to remarkable data. Investors poured $50 billion into the tech industry in 2021 simply because of the attractiveness of the industry. Not everyone is happy about this development. However, many worry that the control of large tech companies is increasing, leading to power and financial inequality. As a result, the Chinese government began tightening regulations in 2020, marking a clear shift in its policy on managing tech companies. I believe that this shift is not simply a response to the rise of tech giants, but also an effort to build a more sustainable and responsible tech ecosystem. And this is the necessary background for us to explore the challenging journey of Chinese tech giants in this video. Main causes of intervention. As China's tech industry has grown exponentially, the government has introduced strict regulations to control the sector. I see three main reasons for this interference: strict regulations, unfair competition, and social inequality. Strict regulations. First, with the explosion of tech giants, the government felt the need for tighter regulation to ensure market safety and stability. One of the main drivers was consumer protection. Data security and personal information scandals have raised concerns among consumers. According to a survey by a market consulting firm, nearly 73% of people expressed concern about the misuse of their personal information. Therefore, the Chinese government enacted the Cybersecurity Law in 2017 and the Personal Information Protection Law in 2021 to strengthen regulation and protect consumer rights. Unfair competition. Next, in this competitive technology market, large companies often implement extremely aggressive pricing strategies to capture the market. We have witnessed a fierce price war between e-commerce platforms such as Alibaba and JD.com, sometimes reducing product prices to unprofitable levels. This competition not only causes economic losses for the companies themselves but also affects consumers. In 2021, Alibaba's revenue dropped for the first time in its history due to unsustainable promotion policies. The government is concerned that this could lead to an imbalance in the market, increasing financial risks, social inequality. Finally, another serious issue is the social inequality that tech companies contribute to. In an already unevenly growing economy, the rise of tech giants has highlighted the gap between the rich and the poor. One study found that by 2024, the richest 10% of Chinese will own nearly 70% of the country's wealth. This divide not only creates social problems, but also puts pressure on the government to find ways to regulate to reduce inequality. Consequences of tightening regulations. Impact on tech companies. As the government imposes strict regulations, the first impact I've seen is a marked change in the revenue and growth of tech companies. Alibaba, for example, reported a 1% drop in revenue in the second quarter of its fiscal year 2022, marking its first revenue decline in 17 years. The tightening of regulations around consumer protection and fair competition has forced companies to adjust their business strategies, from reducing promotional campaigns to increasing investment in security technology and legal compliance. In addition, some tech companies have delayed their plans to list shares on the US stock market or even pulled out of their IPOs. For example, Ant Group, a subsidiary of Alibaba, had to halt its $37 billion listing in late 2020 due to government intervention. This not only limits the growth potential of companies but also affects the overall development of the technology industry. Venture capital investment has also been affected. David Liu, a prominent venture capitalist, said that investors are feeling nervous and there has been a decline in investment in technology startups, with total investment down about 30% in 2022 alone. Implications for consumers and the labor market. Increasing regulation affects not only tech companies but also consumers. On the one hand, increased consumer protections, such as account data privacy regulations, are great, but on the other hand, these regulations can lead to reduced diversity and competition in products and services. Some forecasts suggest that the cost of online services could increase as companies are forced to invest more in regulatory compliance, leading to financial pressure on consumers. According to a study by the China Institute of Economic Research, more than 40% of consumers said they were willing to pay more for technology services if quality and privacy were guaranteed. However, this also raises the question of whether consumers can afford it in a difficult economic environment. The labor market is no exception. Many companies have had to cut staff to save costs amid the new regulations. By the end of 2022, nearly 10,000 tech jobs had been cut, especially in departments like marketing and product development, where operating costs are being more closely scrutinized. Despite the difficulties and challenges, the tightening of regulations also opens up opportunities for China's tech industry. This could lead to a fairer competitive environment, which in turn promotes sustainable development in the long term. We will see how the tech industry adapts and develops in the near future. Future prospects for China's technology industry. China's tech industry has been through a rough patch under heavy government intervention. However, the future remains bright for the industry, and there could be some notable shifts in tech companies' strategies. Predictions on recovery and changes in strategy of technology companies. First, I see that big tech companies like Alibaba, Tencent, and Baidu are starting to adjust their strategies to fit the new landscape. In a recent Deloitte report, nearly 65% of tech executives said they have adjusted their business models to better suit new regulations and consumer demands. For example, Alibaba has announced plans to transition to a more sustainable business model, focusing on developing sustainable products and services, reducing its reliance on advertising and promotions. I also note that they have invested in green technology, with a goal of reducing their carbon footprint by 20% by 2025. This not only helps Alibaba meet environmental regulations, but also appeals to a socially conscious customer base, an increasingly large segment of the modern consumer market. In addition, Tencent has launched the Digital China initiative, aimed at promoting the digitalization of traditional industries such as agriculture and manufacturing. They plan to invest about $20 billion in technology projects over the next 5 years to improve competitiveness and sustainability. Why is this change necessary for sustainable development? This strategic shift is essential for the sustainable development of China's tech industry for several important reasons. As I mentioned, consumer protection and data privacy regulations will become increasingly stringent. Changing business models will help companies comply with these requirements, thereby minimizing the legal risks and costs of non-compliance. According to a PwC survey, 82% of technology executives said that adjusting their strategy to comply with regulations is a top priority in the short term. Businesses today are facing increasing pressure from consumers and investors to operate responsibly and sustainably. According to McKinsey research, 70% of consumers are willing to pay more for products produced by companies that are committed to sustainability. This is driving companies to innovate and offer products and services that not only meet current needs but also protect the environment and society in the future. Rather than seeing regulation as a hindrance, I see it as an opportunity for tech companies to find new markets. Green technology, artificial intelligence, and digital transformation are emerging as strong growth areas, and companies can increase their revenue by investing in these areas. Forecasts show that the AI market in China could reach $100 billion by 2025. If companies catch on to this trend, with positive changes in strategy and a vision for sustainable development, China's tech industry can not only recover from the current crisis but also thrive in the future. The tech industry will play a key role in shaping the Chinese economy in the coming years. And it will be interesting to see what kind of innovations we will enjoy. In this video, we explore why the Chinese government is interfering with tech giants, and the future prospects of China's tech industry, a sector that faces many challenges but is also full of opportunities. I'd love to hear your thoughts on this topic. If you have any questions or thoughts on the future of China's tech industry, feel free to share them in the comments below. If you found this video interesting and useful, please subscribe to the channel so you don't miss out on the latest content. Share this video with your friends and family so we can discuss and learn more about the exciting changes in the technology industry. Thanks for watching, and I hope to see you in the next videos.